Hello everyone, let's go through markets today in Android Market Prep. So let's look at the dollar first, and you can see it in left upper corner. This is the XY index, the candlestick chart. And we can see that we've been pretty overextended. The dollar has been growing since June, and this is a pretty established trend, and we even managed to break above 150 level, if you can see from weekly chart. So technically speaking, on the higher time frame, this is a pretty bullish situation. However, if we look at lower time frames, and even on weekly chart, the current week has been retracing down, and it seems like we are closing right in the middle of the weekly range, which makes a big upper wick. That is not a bullish sentiment in the short term. So if we look at intraday charts or swing charts, say 4-hour chart, we can see some pulling back happening now. So, and I believe there is a reason for that. First of all, technically speaking, the prices are quite stretched to the upside. And also, oil has been going down since some resolution in Iran conflict, which surprisingly doesn't pull down the dollar after itself. And that's because currently the dollar is driven by hawkish expectations. So investors expect the Fed to keep hiking rates because inflation is sticky, GDP growth is good according to the latest data, and also I'm looking at calendar now. So on June 25th, personal income and personal spending also beat the consensus, along with GDP growth rate quarter over quarter. So those are pretty bullish signals for the dollar. And I believe market has been expecting stuff like that even prior to the actual release. And when we did release, there was no follow through. If you see, this is the candle where the GDP and personal spending released. We actually sold off on that release. Why? Well, it looks like buy the rumor, sell the fact reaction. So the market has been pricing in the hawkish sentiment and all sorts of hawkish news. And when the data did released, the investors just started taking profits, and that's why the dollar isn't appreciating anymore. Instead, we are in a sort of distribution phase. And it's been 1 hour since London opened, almost 1 hour, 55 minutes. And what we see is the dollar doesn't show any signs of recovery. So one reason for that is stretched market, right? Buy the rumor, sell the fact situation. This is one factor that's dragging dollar down. Another one is that oil has been in a strong downtrend because the fundamental reasons for keeping oil higher are dissipating. So other than hawkish sentiments, there is not much left for the dollar to stay high at this point. So I believe eventually there should be a pretty decent, at least a correction to the recent dollar strength. And to top it up with, if we look at yields, so this is on the left, this is a yield chart. So the dollar is obviously dark green. This is a DXY index. And 10-year US bonds is the blue line. So if you see, since about, let's step to the 4-hour time frame. It's a bit messy here because I'm also tracking the inflation protected bonds here. From about May, or yeah, even early, basically April, March, since the beginning of the conflict in Iran, yields or dollar pretty much follows 10-year yields. But now, if you look at the middle of June, it was still following. So yields fell, dollar fell. I'm looking at the blue line and green line here. So yields fell, dollar fell, yields fell, dollar fell, yields recovered, dollar recovered. Yields recovered 18th of June, dollar recovered and continued its strength higher and higher. However, yields pulled back sharply, then tried to recover while dollar even strengthened even more. However, after that, yields have been trending downwards without looking back, but dollar isn't so fast pricing it out. So either dollar should converge with yields by moving down, or yields should converge with dollar by going up. In this case, bonds should sell off. However, bonds at this point seem to be tracking oil, as bonds represent more of inflation expectations. And if we look at TIPS, which inflation protected bonds, the pink line, this is actually, the pink line is actually the bond price, not the yield. So the bond price of TIPS, inflation protected bonds, are going higher at the same time. So they confirm that markets expect lower inflation. When a bond price goes up, yields go down. So inflation protected bonds went up, and that means they squeeze out yields. Yields become smaller. So markets expect lower inflation according to the bond yields. So why would dollar prices stay high at this point? I am not sure. If there is a geopolitical uncertainty decreasing in the Middle East, oil prices are going down, inflation didn't beat the consensus. If we look at the economic calendar, core PCE price index month over month released in line with consensus, 0.3%, and consensus was 0.3%. So inflation didn't show anything crazy, and oil is going down, conflict is getting resolved gradually. Even there are some reports that tankers start coming through. So I believe next week we will see some dollar weakening. And at the same time, because dollar is so stretched, the central bank that hates a situation like this is Bank of Japan, of course. And we reached intervention levels. Last time BOJ intervened was in the beginning of July, you can see. And dollar yen went down almost 13%. So now we are approaching this level, 162 yen per dollar. And this is another big reason why holding dollars in the short term is not the best idea, I believe. So I am looking for some short selling opportunities to short dollar against yen here. I've already marked a short-term support zone at 161.60. It's pretty messy here, long weeks, and it's also the end of the month, so a lot of funds, institutions, they are rebalancing portfolios, hedging, and all sorts of random stuff going on at the end of the month. So gotta be careful. However, I see a nice technical pattern forming here with the support area at 161.60, and I will look for shorting this pair if 4-hour chart closes reliably somewhere under 161.50. So this is interesting, and obviously if BOJ intervenes eventually, that will be a home run. If anybody can catch a move like we had in July, that's just amazing. So this is one idea. There's another idea. Another asset I am watching is S&P 500. Obviously, we are seeing some short-term range here, and hawkish pressure that's been holding this index from recovering higher. And we have a range that's been forming for the last few days, and we broke below local level 7,380, and then we broke a major support area, this blue area, 7,360. So now there's an attempt to recover in the pre-market. So what I'm looking for is rejection of this blue area and this local level, and I would like to short it maybe during first hour or two of New York session. So dollar is high, which is not a good sign for risk assets, plus hawkish expectations. So that's a good environment for shorting risk assets. And also because S&P has tech presence, and tech has been hit quite by disappointing news that OpenAI IPO has been delayed, and especially it it expressed this news expressed themselves in Nikkei index. You can see that it sold off from opening. Why? Because SoftBank is one of the most impactful companies that affect Nikkei, and SoftBank actually owns a big share in OpenAI. So because IPO is delayed, financing is delayed for the company, so it's bearish, and basically it pulls the whole tech sector down, and the most exposed, one of the most exposed tech instruments are Nikkei and also Nasdaq, obviously, and we can see it almost identically tracked Nikkei, and S&P is also pretty exposed to tech, so that's a factor to consider, the bearish factor for S&P. Yeah, and the last idea that I wanted to share is Euro Pound. Well, first, that you can notice on weekly chart, look at this beautiful support at 0.862520, and this compression, if it resolves in either direction, technically speaking, that may be a massive move. And what we are observing here is that it tried to break down, but then it recovered. So we are seeing potentially a false breakout. So technically speaking, I'm looking now towards going higher, and there are also some modest fundamental reasons for that. So if you compare forward guidance and behavior of ECB and BOE, they are pretty similar. Both expect weak growth, both struggle with inflation. However, ECB has already taken concrete steps into coping with inflation. They hiked interest rates. However, BOE, the Bank of England, they take more of a wait-and-see approach. So at this point, European Central Bank is slightly more hawkish than BOE, and that's one of the fundamental reasons to buy Euro Pound. Another reason is simply because Europe is more exposed to oil, and it benefits from cheap oil prices. And what we are seeing here is oil is in a downtrend, right? And the UK benefits from higher oil prices because there are a lot of international oil companies that earn from abroad, British companies. British Petroleum is one of them. So in theory, higher prices or lower prices, for oil should not be beneficial for the British pound. Therefore, fundamentally, I lean towards a bullish setups here. And also, seasonally, Euro Pound looks favorable as well. Now, what was the alert from dollar yen about? Some little down move here. Okay, I'll keep monitoring it, and I would like it to close reliably on 4-hour chart below this level, below 161.50, I guess. Okay, so that's it for today. We looked through three potential ideas: dollar yen, S&P 500, and euro pound. So this is the end of the week. This is the end of the month. A lot of rebalancing, repositioning, hedging happening, a lot of random moves. So be vigilant, and see you in the next Andrew Market Prep.